Hi, I'm Wayne Zell, and welcome to Blueprint for Wealth, a fast-paced video cast dedicated to helping you realize your personal dreams of wealth and freedom. Blueprint for Wealth is brought to you by the law firm of Zell Law, located in Reston, Virginia and Savannah, Georgia, and serving clients all across the country. If you'd like to know more about us, visit us on the web at zelllaw.com. Today, before we get to our special guest, we're going to be talking about the qualified small business stock exclusion. It's undergone a lot of changes over the last 30 years, and it just recently underwent some additional change. So let's get to it. So the qualified small business stock QSBS exclusion is only for individuals, partnerships, trusts, and estates. It does not apply to corporations that might own stock in another company. It's under Section 1202 of the Internal Revenue Code, and up until recently, it allowed you to exclude 100% of capital gain on qualified small business stock. The gain exclusion was 100% after September 27th of 2010 up until this year. 75% between 2009 and 2010, and 50% is the current exclusion after passage of the Build Back Better Act. So the effective tax rate is applicable to the gain on the sale of qualified small business stock. It is not entitled to both a partial exclusion and the use of the lower capital gains rates. Any gain that is taxable under Section 1202 is taxed at a rate of 28% instead of 20%, which is the current capital gains rate. In addition, there may be a net investment income tax that's applicable to it. Up until the end of 2021, the net investment income tax only applies to certain types of gain. After 12/31/2021, the net investment income tax of 3.8% applies all across the board. If your facts and circumstances were to result in a higher tax if you applied Section 1202, you can try to fail the 5-year holding period requirement so that you can get better tax treatment. And again, here are the tax rates that apply depending on when the asset was acquired and when the asset was sold. So there's a 5-year holding period in order to qualify for this partial exclusion or total exclusion under Section 1202. If a taxpayer acquires the QSB stock in exchange for property other than money or other stock, the taxpayer is deemed to have acquired the stock on the date of the exchange. There's special tacking rules that apply. If you acquired the stock by gift or by death, you get to tack the holding period of the previous owner. Here's an example. Let's say Y purchases QSB stock on January the 15th in year 1, and then he dies on March the 15th, leaving the asset to B. In year 3, B inherits the QSB stock. Then B sells the stock on January 20th of year 6. B satisfies the 5-year holding period because he gets to tack Y's holding period to his holding period. There's other special tacking rules that apply to partnerships. But in the case of a partnership to a partner transfer, pass-through of Section 1202 benefits to partners who acquire their interest after the partnership acquired the QSB stock is not allowed. And QSB stock treatment and tacking holding periods is permitted in certain non-recognition transactions, such as tax-free reorganizations or contributions to a company in exchange for stock. For any one taxpayer, the maximum amount of eligible gain with respect to the stock of a single issuer that can be subject to the exclusion is effectively no more than the greater of $10 million reduced by any gain taken into account in prior years, and 10 times the aggregate adjusted basis of the QSB stock. So let's say B and C each acquire QSB stock in X Corp for $500,000. B also purchases stock that's QSB stock in Z Corp for $2 million. X Corp and Z Corp are unrelated. B and C then sell all their stock. And all of the other requirements, including the holding period requirements, are met. Assume all the transactions are now subject to the 50% exclusion because it's after September 13th of 2021. B sells her X Corp stock for $12 million. Of B's gain, up to $10 million is subject to relief under Section 1202. So assuming a 50% exclusion, B gets to exclude $5 million, 50% of $10 million, from gross income with respect to the sale of the X Corp stock. B recognizes a gain of $6.5 million, $12 million, minus the $5 million basis, minus $5 million. C sells his X Corp stock for $11.5 million. Of C's gain, up to $10 million is subject to 1202 exclusion, and assuming a 50% exclusion, he gets to exclude $5 million from gross income. So he recognizes gain of $6 million, and it's taxed at a 28% rate. Same facts, except B sells her Z Corp stock for $20 million. Of that gain, up to $20 million is subject to Section 1202. Why? Because it's the greater of $10 million or 10 times the adjusted basis, and B's basis was $2 million. So it's $2 million times 10. Therefore, $18 million of gain realized is subject to Section 1202, and B recognizes $9 million, half of that, with respect to the Z Corp stock, assuming a 50% exclusion. How do you determine the limit? Well, if you transfer property other than money or stock to a qualified small business stock corporation in exchange for stock in the corp, the taxpayer's basis is not less than the fair market value of the property you exchanged. So if C transferred property to W Corp solely in exchange for QSB stock, the transfer is tax deferred. C's basis in the property originally was $60,000, but it had a fair market value of $100,000. So although his basis is $60,000, for purposes of calculating the gain and the exclusion under 1202, it's $100,000 because that's the fair market value. The higher basis number, the fair market value number, also applies for purposes of determining the amount of gain. There are certain transactions that allow you to preserve the status of the QSB treatment. For example, if it's acquired in a tax-free reorg, such as what I was describing, or if you put your property into a new corporation in exchange for stock in a controlled corporation transaction, it also qualifies as QSB stock. For married individuals who file separate, the $10 million limit is reduced to $5 million or 10 times the adjusted basis of the stock. For alternative minimum tax, where the 50% exclusion applied back before 2009, alternative minimum taxable income included 53.5% of the gain, which produced an effective rate of 14% for those in a 26% AMT bracket and almost 15% for those in a 28% AMT bracket. Note that even though the alt-min tax did not apply after September of 2010, the question is whether or not it's coming back to haunt us because the exclusion's been reduced to 50%. In the Build Back Better Act that was passed by the House, taxpayers with adjusted gross income of $400,000 or more, including the gain, would be eligible to exclude only 50% of the gain. So the 100% exclusion still applies for small amounts of gain, But if you have more than that threshold amount of AGI and the transaction occurred after September 13th of 2021, it's a 50% exclusion. This is going to have a significant impact on founders and investors in startup corporations and could make the C corporation form less attractive. Remember that to qualify for QSBS treatment, the entity has to be a C corporation when it issues the stock, and it only applies to US-based C corporations. There's an initial original issuance requirement that must be met, which we won't go into in great detail on today's broadcast. The aggregate gross assets of the corporation also cannot have exceeded $50 million at any time after August 10th, 1993, the date it was enacted, and the date on which the stock is issued. If the company grows in value such that its gross assets are worth more than 50 in the future, that's okay. It will not disqualify you for QSB status. And lastly, and most importantly, QSB treatment is only available to certain qualified trades or business, even though they may be active trades or business. So businesses that are in the fields of health or law, engineering, architecture, accounting, actuaries, brokerage services do not qualify for the QSBS exclusion, nor do banking, insurance, financing, leasing, investing, or other similar businesses, and certain other businesses of operating hotels, motels, restaurants, and similar businesses. So these businesses that I just spoke about do not qualify for QSB treatment. If you've got questions on the qualified small business stock exclusion, give us a call at 571-203-9355 or look us up on the web. Send us an email. Contact us at zelllaw.com. I'm Wayne Zell. You're listening to Blueprint for Wealth, and stay tuned for our special guest.